Okay, so let's start. I'm just Preet on this side, and so far we have made 10 videos on revision of Companies Act 2013. I'm using this book Saransh by ICAI, Institute of Chartered Accountants. I'm company secretary by profession, and this is a disclaimer that this is only for revision purpose, and for any practical life application, please refer updated laws. So let's proceed with our today's topic. In our 10th video, we covered extraordinary general meeting, notice, quorum, proxies, voting, resolutions, minutes, and now let's start with dividend. So our topic starts with dividend. Dividend payable on different types of shares. So first of all, dividend is paid only on shares. Like there are securities like debentures, bond, and interest is paid on them. So for the purpose, dividend shares can be divided into two parts: preference shareholders and equity shareholders. In preference shares, we have cumulative preference shares or non-cumulative preference shares. In cumulative preference shares, dividend accumulates unless it is paid in full. So in case of cumulative preference shares, dividend keeps on accumulating unless it is actually paid in full. And in case of non-cumulative preference shares, no arrears of dividend in future. So arrears of dividend are not carried forward to be paid in the future. Equity shares. Equity shares dividend dependent on dividend policy and the availability of profits. Here the word is availability of profits after satisfying the rights of preference shareholders. So in case company has issued preference shares, then preference shareholders will get right of preference over payment of dividend to equity shareholders, and then as per dividend policy and as per the availability of profits, dividend will be declared. So based on availability of profits, first company will propose a dividend, certain percentage or number or amount of which dividend can be paid per share, how much rupees dividend can be paid, and then that will be approved by shareholders in general meeting, and then it will be paid. If there are no profits, if board do not propose, then dividend is not required to be paid in case of equity shares. Section 2, subsection 35 of the Companies Act states that dividend includes interim dividend. What is interim dividend? Interim dividend is dividend that is paid during the year, and it is not based on financials of the end of the year, that is 31st March. Declaration of dividend, section 123. Section 123 relates to declaration of dividend. Dividend can be declared out of, first is current year profits after depreciation. So first we will make provision for depreciation, and then out of the available profits we can make payment of, we can declare dividend. Number two option is out of the profits of the company for any previous year or years arrived at after providing for depreciation in accordance with Schedule 3rd and remaining undistributed. And next is or both. So it can be utilizing current year's profits, it can be utilizing previous year's profits after making provisions for depreciation. After providing for depreciation, this can be paid, and depreciation will be provided in accordance with Schedule 3rd and remaining undistributed. So or both. Next is dividend can be declared out of money provided by the central government or state government for the payment of dividend by the company in pursuance of the guarantee given by that government. So if government has given any guarantee as to dividend, then it will be paid. Dividend will be provided by central or state government as may be provided. So for usually in our cases, usually there is no guarantee by government, so in our cases we can use current profits or previous past profits. Transfer to reserve. Now before declaration of dividend, transfer such percentage of its profits for that year as it may consider appropriate, that is left at the discretion of the company. So company can transfer. Now here right word is may. It may consider appropriate. So how much percentage of profit is to be transferred to reserves? Reserves are maintained for future. So that is at the discretion of the company. But a provision is that certain portion should be transferred to reserve. Depositing amount of dividend. Now, amount of dividend including interim dividend shall be deposited in a scheduled bank. This will be deposited in a scheduled bank in a separate bank account within 5 days from the date of declaration of dividend. So, dividend is declared, okay, then it is approved in the general meeting by the shareholders, then within 5 days it should be deposited in a separate bank account, and that should be a scheduled bank in a separate bank account within 5 days from the declaration of such dividend. Board proposes and shareholders approve, declare. Exception is government company in which entire paid up capital is held by central government or state government or combination of central and state government. So a government company in which entire share capital is held by the government itself. So for that this requirement is not present, that dividend be deposited in a separate bank account within 5 days. In all other cases, which is the usual scenario, if dividend is declared and approved, then it should be deposited in a separate bank account within 5 days. Next, we move to rules to be followed while declaring dividend out of reserves. So we discussed that dividend can be paid out of current year profits or from the previous year profits. Now dividend, if we want to pay dividend out of the reserves, so now first condition we will check is relating to rate of dividend. What shall be the rate of dividend at which dividend can be declared out of reserves of the company? So for declaration of dividend out of reserves, rate will be calculated by a formula depending on dividend paid in the previous 3 years. So we will take average of the dividend paid in previous 3 years, where rate of dividend can be equal to or greater than rate of dividend in previous year, rate of dividend prior to that, rate of dividend even prior to that, divide by 3 average we have taken, and where RD1, RD2, RD3 are rates at which dividend was declared by it in the 3 years immediately preceding that year. However, in case this rule will not apply if the company has not declared any dividend in each of the 3 preceding financial years. So if in each of the 3 preceding financial years dividend is not declared, then we can skip this requirement that rate is to be determined by taking average of previous 3 years. Number two point which we have to consider is the total amount that can be withdrawn from accumulated profits. So from past accumulated profits in the reserves, what is the maximum total amount? First was rate, then maximum amount money which can be withdrawn is 1/10 of paid up capital and free reserves. Paid up share capital means equity and preference both are covered. Total paid up share capital plus free reserves, and we will take 1/10 of this as per the latest audited financial statement. So last available latest audited financial statement will be taken. 1/10 of paid up share capital and free reserves will be calculated, and total amount which can be withdrawn, which can be paid out as dividend, cannot exceed 1/10 of the total paid up capital and free reserves. Drawn amount be first utilized to set off losses incurred in financial year in which dividend is declared. So drawn amount, the amount which we have drawn to be paid out as dividend, that will be first utilized to set off losses incurred in the current financial year in which dividend is being declared. Then next is balance of reserve after drawal of amount. So what first was rate, second was how much can be withdrawn, then after withdrawing of amount, how much balance should remain in reserves. So balance of reserves after withdrawal should be greater than or equal to 15% of the paid up share capital as per latest audited financials. So 15% of the complete paid up capital. When I withdraw, then it should not be 1/10 of paid up capital plus free reserves, and the reserves which will remain after withdrawal shall not be lower than 15% of paid up capital, total capital. Payment of dividend. Payment of dividend. So payment in, payment to, and Nidhi company. So payment of dividend. First, dividend is payable in cash. Dividend is payable by check. Dividend is payable by warrant. Dividend is paid by electronic mode. Regarding cash, I have doubt. I think cash is not allowed. The modes in which dividend can be paid are check, warrant, electronic mode, direct bank transfers. Payable to. Next is payable to whom the dividend is payable. The dividend is payable to the registered shareholder of the share, means the registered shareholder will be paid, or to his order, or the registered shareholder can order that this be paid to this person, or to his banker. The bank details will be provided by registered shareholder, that person be paid. Suppose registered shareholder is not the beneficial shareholder, then in that case also registered shareholder will provide details of the beneficial shareholder and that be paid. So payable to registered shareholder or to his order or to his banker. Payable to registered shareholder or to his order, whom the registered shareholder will order, or to his banker. Now, in case of Nidhi companies are mutual benefit companies. So any dividend payable in cash may be paid by crediting the same to the account of the member if the dividend is not claimed within 30 days from the date of declaration of dividend. So in case of Nidhi company, dividend is declared, then members can claim. If in 30 days they do not claim, then that amount can be credited to the bank account of the member. This is a special case of Nidhi company. So regarding payment of dividend, it can be paid by warrant, check, electronic transfer. It is payable to registered shareholder or to person a registered shareholder provide, or directly to the banker of registered shareholder. Then next we move to unpaid dividend account, section 124. Section 124 deals with unpaid dividend account. Dividend is declared. Now dividend is declared within 5 days. We have to deposit it in a separate bank account. And now dividend declared after 30 days, if still the amount is unpaid, then dividend not paid or claimed. 30 days time has passed and dividend is still kept in that separate bank account, being unpaid or being unclaimed. Then within next 7 days, deposit the unpaid or unclaimed dividend amount in a scheduled bank called unpaid dividend account. So since we opened our primary bank account with the scheduled bank, usually what happens is after 30 days the same bank account name is changed to unpaid dividend account. So first the name of account can be dividend account of XYZ company, and now the account name becomes unpaid dividend account of XYZ company. This is what is practically done. If this is not done, then pay interest at 12% per annum from the date of default. If that account name is not changed, that separate bank account and unpaid dividend account is not created, then pay interest at 12% per annum from the date of default. Prepare statement, name, last known address, unpaid dividend amount. So now a statement will be prepared in which we will provide name of the shareholder, last known address, the last known address of the shareholder, unpaid dividend amount, and the amount of dividend is unpaid. This statement will be prepared, that we have to identify the amount contained in unpaid dividend amount relates to which shareholder, and what was the last known address of that particular shareholder whose dividend is remaining unpaid. Name and last known address. This statement is to be prepared. Next, place on website. This statement containing name of unpaid shareholder and his last known address of unpaid shareholder is placed on the website of the company, and website approved by government for this purpose, and any website which is approved by government for this purpose. After the expiry of 7 years, what happens is, first in 30 days dividend is unpaid, then dividend is transferred to unpaid dividend account. From the moment this dividend is transferred to unpaid dividend account, from that day we will count 7 years. If 7 years expire and the amount is still kept in unpaid dividend account, then that amount will be transferred to Investor Education Protection Fund. That amount will be transferred to IEPF, Investor Education and Protection Fund. Investor Education and Protection Fund. Transfer to Investor Education and Protection Fund after 7 years, from which date? From the date of transfer to unpaid dividend account, which was to be done within 7 days of expiry of 30 days from the declaration of dividend. And what has to be done within 5 days of declaration dividend? That amount which is to be paid as dividend is transferred to a scheduled bank separate bank account. Okay. Any person claiming for the amount transferred in unpaid dividend account may apply to company for the payment of money claim. So during this 7 years phase, any person claiming the amount transferred to unpaid dividend account, that a person can apply to company for the payment of money claimed. Punishment for failure to distribute dividend. If dividend is declared and it is not distributed, then section 127 provides punishment. Declared dividend not paid or warrant not posted within 30 days from the date of declaration. If default is on the part of company has not issued dividend warrants, company had not made payments to the dividend holders, then consequences. The consequence will be every director, if knowingly a party to the company and the company. So what will be the consequence for every director? If knowingly party to default, he was aware of the default, the resolution was passed in his presence, and he was aware that this has not been distributed. So every director knowingly party in case of default will be punishable with less than or equal to 2 years. Being less than or equal to 2 years means it can be 1 day also, because 1 day is also less than 2 years, 0 days is also less than 2 years. So since imprisonment, if this imprisonment requirement states that it will start from minimum 1 year and then maximum 3 years or something, then it is a matter of concern, greater concern. Still, it is a matter of concern that there is a possibility of imprisonment in case director knowingly was involved in non-payment of dividend to a shareholder. Imprisonment less than or equal to 2 years, and fine also, and or fine less than or equal to 1000 per day during which the default continues. And in case of company has to pay simple interest at 18% per annum. So company has to pay simple interest at 18% per annum in case of non-payment of dividend within 30 days to a shareholder member who was entitled to it, and there was no concern regarding his finding his bank account, his details. Exceptions under which no offense shall be deemed to have been committed. Now exceptions. These are the exceptions in which cases it will not be deemed to have been committed a default. Exceptions to Section 127. Dividend could not be paid by reason of operation of law. Legally, it was bar on payment of dividend, or there were certain requirements of law that stopped company from payment of dividend. Number two, shareholder gave directions regarding payment of dividend. There were certain directions, instructions from shareholder that dividend be paid to this person, then that be done. Dispute regarding right to receive dividend. If there is a dispute who is the actual shareholder to be paid the dividend, then in that case also dividend can be kept on hold. Dividend has been lawfully adjusted against any sum due from shareholder to the company. Ideally, this is not done. Still, if lawfully it is allowed that any sum is due from shareholder to the company and dividend is adjusted with that, lawfully only it can be done. Next is for any other reason, the failure to pay or post dividend warrant within prescribed time was not due to any default on the part of the company. It can be any reason, but it was not a default on the part of the company. And those directions cannot be complied with and the same has been communicated to him. So this is only relating to exception number second, that shareholder gave directions regarding payment of dividend and those directions cannot be complied with and the same has been communicated to him. So shareholder communicated that this dividend be paid to this person, or I be accumulated and paid dividend after 5 years, and the company has clarified that this special requirement cannot be entertained. So in this case also, if dividend is delayed or not paid, then company is not liable. If company is liable, then company has to pay simple interest at 18%, and directors knowingly party to non-payment of dividend is liable for imprisonment up to 2 years and fine of rupees up to 1000 per day. Okay. Next is accounts of companies. Accounts of companies. Financial statement. Section 128 and 129. Financial statements. Section 128 and 129. Financial statement is defined under section 2, subsection 42 includes. So financial statement includes the following. Number one is balance sheet, basic. Number one is balance sheet, which is prepared as on last day of the year. Balance sheet as on 31st March of the year. Number two requirement of financial statement is profit and loss account or income and expenditure account. So like in case of section 8 company, non-profit company, then in that case, so second part of financial statement is profit and loss account or income and expenditure account. This is prepared for the complete year, that during the year, at end of the year, this is the profit, these are the expenditure, these are the income, and the profit and loss is calculated. Now next is number 3 is cash flow statement. To certain companies it is mandatory to maintain cash flow statement, and there is one fund flow statement also. Next is statement of change in equity if applicable. If there is change in equity, then a statement of change in equity will also form part of financial statement. Then any explanatory notes annexed to or forming part of financial statement. So we always see notes to financial statement, then those notes also form part of financial statements. Next is that in case of one person company, small company, dormant company and private company or a startup, may not include cash flow statement. So as we were talking about cash flow statement, then this is not applicable to all the companies. So cash flow is not applicable to one person company. Cash flow is not applicable to small companies. Which is a small company? A small company is one where paid up capital is less than 4 crores and turnover is less than rupees 40 crores and it is neither holding or subsidiary company. It is not a Section 8 company. It is not a company under special act passed by Parliament. So a small company is not required to prepare cash flow statement. Dormant company is not required to prepare cash flow statement. Private company is also not required to prepare cash flow statement. So if it is not a small company, it is a standard private company, then also not applicable. However, for deemed private company, because by deeming provision it becomes a deemed public company, a private company which is deemed to be a public company, then it will become applicable. And startup company means which has got a certificate to be termed as a startup, then that company is also not required to prepare cash flow statement. So in general we will see balance sheet, in general we will see profit and loss account, in general we will see explanatory statement annexed to the financial statements. Financial statement shall give true and fair view of state of affairs of the company. So it will give true and fair state of affairs of the company. It will comply with accounting standards and be in form as provided for different classes of companies in Schedule 3rd. So the structure, what will be written first, then what will be written, this structure. Financial statement will comply with this structure form in which it will be prepared as provided in Schedule 3rd for various classes of companies. It will comply with applicable accounting standard in this applicable or other, so that will be complied, and it will give true and fair view of the state of affairs of the company. If financial statement do not comply with accounting standards, so if a financial statement do not comply with accounting standards, then reason for deviation for such deviation will be given along with financial effects. Then what is the effect of such deviation and need to be disclosed, this needs to be disclosed. So if complete accounting standard is not followed or a certain accounting standard is not followed, then reason why it is not followed and what is its effect on the financials of the company, that be disclosed in the financial statements. So even if we have standard assumptions, if those assumptions are also changed during the year, so if in case of background change of assumptions, then that we also disclosed, reason for that we also disclose, and its impact we also disclosed. Periodical financial results, section 129. Periodical financial results. The central government may require prescribed unlisted company to prepare financial results of the company on periodical basis. Just like in the case of listed company, we require to prepare financials on quarterly basis. For certain companies, financials are required to be prepared on half yearly basis. So similarly, central government may require certain unlisted companies also to do the same. So to prepare financial results of the company on periodic basis, to obtain approval of board of directors and complete audit oblique limited review of such periodical financial results. It will complete audit or periodic review, and it will be passed with approval of board, and file the copy with the registrar within 30 days of completion of relevant period on payment of fees. So this be also passed with the registrar, just like we file our annual financials in form AOC4 XBRL. Similarly, this will be filed in the prescribed form if the central government prescribes that certain class of unlisted company shall prepare financials on periodical basis. This is section 129A. Next is laying of financial statement. So now laying of financial statement. If a company has subsidiary consolidated financial statement, if a company has subsidiary, then a consolidated financial statement is also to be laid before annual general meeting. Only consolidated financials are required. Consolidated audit report is required, but consolidated director's report is not required. So in case company has subsidiary, then consolidation of financials is also mandatory. At each AGM, the board of directors shall lay the financial statement for the financial year. So in each AGM, number one, ordinary business, we have already discussed ordinary business and special business. So one of the four ordinary business and the first one of the four ordinary business is laying of financials, and in case of subsidiary, consolidated financials and standalone financials both, along with auditor's report on both and director's report on standalone financials before the annual general meeting, and also before the board of directors. First board will approve and then it will go to annual general meeting. Maintenance of books of accounts. Company shall prepare books of accounts, books and papers, financial statements. So company shall prepare books of accounts, books and papers, financial statements. Keep at its registered office or any other place in India as the board of directors may decide. So board can decide that these will be placed at registered office or any other place in India. Open for inspection by directors. This is open for inspection by directors. Books of accounts of the subsidiary can be inspected by a person only on authorization by board of directors. So subsidiaries books of accounts can also be inspected on the authorization by board of directors resolution, and other financial information outside India on written request by director himself. So financials are open for inspection by directors. If it relates to financial information of outside India, then at the request of director himself, and if it is books of accounts of subsidiary, then only on authorization of board of directors resolution. Now financials are to be preserved for 8 years. Financials are to be preserved for 8 years. Books of accounts are to be preserved for 8 years. Books and papers relating to books of accounts and financial statements are to be preserved for 8 years. Failure in compliance. If there is a failure in compliance, then fine can be imposed ranging from rupees 50,000 to rupees 5 lakh. If there is failure in compliance, then fine can be imposed ranging from rupees 50,000 to 5 lakhs. These are to be maintained for 8 years. They are to be open for inspection by directors, and they have to be placed at registered office or any other place in India as the board of directors may decide. A form will be filed with the registrar of companies. Okay, so next, reopening of accounts. So this we will start tomorrow. Reopening of accounts, financial statement, board's report. So let's continue this tomorrow. This was 11th video. Disclaimer that this is only for revision purpose. Thank you.